it goes well beyond the dystopic view George Orwell put out in his book in 1984.
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Dr. Thorsten Polleit. Dr. Polleit is an economist and professor of economics at the University of Bayreuth in Germany. He's also a contributor to the Mises.org website, and I've been reading his stuff for many, many years. Back in 2005-07, that's how I first got in touch with Dr. Polleit. He even used to work for one of the big banks, and now he's independent. And I wanted to have him on to talk about the money supply situation, not only in the US, but in Europe, because it seems to be getting very serious. And there's a big confusion, of course, nowadays between inflation and CPI and what really is inflation. And I think Dr. Polleit would do a great job explaining to us what's going on. Welcome, Thorsten.
Mario, thank you very much to be on your show. It's a great pleasure, as always.
You're welcome. And I don't know if you remember Dr. Polleit or Thorsten, I can call you Thorsten. Back in 1994, when the Bundesbank hadn't been taken over by the ECB, they used to target M3. And I remember one day the M3 came out at 30%, and the Bund market dropped 3 points. It was the busiest day in my career as a futures and options broker. But nowadays, none of the mainstream economists or traders seem to care about the monetary aggregates. So what can you tell the viewers and the world about what's going on?
Inflation is a complex issue, and I think it's important to distinguish between two concepts. On the one hand, we have goods price inflation, and on the other hand, we have monetary stock inflation. And I would argue that goods price inflation, so if prices of consumer goods or producer goods go up over time, is actually the result of an increase in the money stock. So the goods price inflation is a symptom of an underlying cause, and the underlying cause is monetary inflation. Nowadays, people think whenever they hear about inflation, they think of consumer price indices, statistical indices that try to basically measure the developments of goods prices in an economy. And I think this is from very unsatisfactory from an economic theory viewpoint, because I said earlier that monetary inflation is actually what inflation really is. That is the driving force. If the money stock in our economy expands, sooner or later that will show up in higher goods prices, be that consumer goods prices or producer goods prices or housing prices or stock prices or even bond prices. Milton Friedman, the famous American economist, he came up with this famous dictum, inflation is always and everywhere a monetary phenomenon. I think that is true from an economic viewpoint, from an empirical viewpoint. And I think the sky-high inflation we have now in the United States of America, in Europe, in the UK, in Germany, is actually a direct result of central banks having ramped up the money stocks big time. For instance, since the end of 2019, the US Fed has increased the money stock M2 by around about 40%. The European Central Bank has increased the money stock M3 by around about 25%. As a result, a huge monetary overhang has been created, and this huge monetary overhang is now getting into contact with cost push effects from green policies, from Russia, from sanctions leveled against Russia, and basically pushes up all prices over time. And just to cut a long story short, the inflation people have to endure, people have to suffer from, is made by central banks' increase in the money stock.
Yes, and there's a very big incentive for the governments and central bankers to blame everything but themselves. And there was an impact from the sanctions against Russia and also from COVID, but that just exacerbated the increase in the money supply and exacerbated the CPI, or if you want to call it inflation, right?
Yeah, you're absolutely right. The monetary system we have is a fiat money system or an unbacked paper money system, where central banks in close cooperation with commercial banks increase the outstanding stock of money through bank credit. And that is, of course, a very profitable business for the banking industry. And it also very helpful for the government because it can issue ever greater amounts of debt, which are then purchased by banks, central banks or commercial banks at relatively low interest rates. And so the government can spend on a very large scale. It can spend more than the typical tax revenues it gets. And of course, this is an inflationary scheme. And in order to make people believe that central banks fight inflation and that even a rise of 2% consumer prices over time is not inflation, we have all these mainstream economists who tell people that we need central banking, we need the creation of new money through bank lending. And all this is meant to basically legitimize an inflationary scheme, which is of course helpful for some special interest groups like the big industry, big banking, and of course the government. But it is very harmful for the society at large. And I think it's important to educate people, as you do in all your videos, about the negative effects of fiat money, of this unbacked paper money system for the public at large.
Yeah, the other interesting thing that's going on, though, is that now we're seeing the monetary aggregates go negative, which would basically mean that we have deflation. And people would probably think we're crazy to say we've got deflation, but we do. And at the same time, the CPI indices are still really high. And maybe you could touch upon that, what you think will happen when the central bankers and governments realize they have to pump up the monetary aggregates again, or else the economies will go into a deep depression. We saw the German fourth quarter GDP, it came out negative. I think it was expected to be positive. So maybe we could touch upon that now.
Yeah, central banking causes boom and bust cycles. You know, they first increase the stock of money, and that makes the economy expand. And sooner or later, this boom turns into bust because the stimulus is actually fading out. And I think this is exactly what's unfolding before our eyes. As I said earlier, since the end of 2019, central banks increased the money stock substantially, creating a huge monetary overhang. And this monetary overhang has ramped up prices across the board. And now, in the last months, central banks have increased interest rates. So the demand for credit has declined and the supply of credit has declined. And that has led to a slowdown in the growth rates of monetary aggregates, as you said. For instance, in the United States of America, the monetary aggregate M2 declined last month by 1.3% year on year. That was the first contraction since 1959. And in the euro area, for instance, the money stock M1, deflated by consumer prices, is shrinking at a rate of around about 7%. And that, of course, is a huge impediment for economic expansion. And I would say, first of all, we're heading for really tough times. I could imagine that the business cycle slowdown will be much more pronounced in the United States and in the euro area, as most people believe at this juncture, because most people don't pay attention to the development of this so-called real monetary aggregates. And the second issue is, of course, there's still this monetary overhang, and this keeps pushing up prices for quite some time, I would argue. And the result would be prices keep increasing, economic activity is contracting, and we're going to end up in a very severe stagflation scenario. It's very unpleasant for people, for businesses. So I'm afraid to say, Mario, we're heading for hard times when I look at what's unfolding as far as monetary developments are concerned.
Do you think that they could trigger a crack-up boom or hyperinflation if, for example, in 6 months they realize that they need to pump up the money and the credit again, and they start cutting rates and doing QE, that it could lead to a crack-up boom, or it could be just a stagflationary period with high inflation, maybe like 10 to 15%. What's your view on that?
I think it's very hard to say at the moment what central banks will do. The one scenario is that they keep raising interest rates until the economy, until financial markets collapse, like we have seen in 2008. Or they deliver just one or two further rate increases and then stop. In the first scenario, I think that's the crash scenario. It wouldn't take long for central banks to lower interest rates, to pump up additional credit and money into the system to keep the economies growing. And that I think could result in some kind of crack-up boom where people start losing confidence in the purchasing power of money, where you don't have a credit crisis, but a currency crisis. So people start getting out of their money holdings, trying to put their money into housing, into stocks and other assets. And that is a likely scenario if central banks at some point, and in the second scenario I just mentioned as well, would return to a policy of lowering interest rates, of backing up credit markets, and most importantly, of pumping up the money supply. Whatever scenario will be unfolding, Mario, I'm pretty sure that we will end up in inflation, in high inflation, that the high inflation we got is basically here to stay. I don't see really inflation to come down for the next 5 to 10 years.
Yes, I think someone did some research that in the last 300 years, if inflation ever gets, or the CPI ever gets to 10%, it takes 7 to 8 years to get it back to 2. So I think they're going to have a hard time. And I think the same people who said the inflation or the CPI was transitory, they're now saying that it's peaked. Could you talk a little bit about that? And also maybe also to protect yourself in these inflationary times. I know you are a gold and silver proponent. Maybe you could talk to the viewers a little bit about that.
I think it's very important, just what you said, Mario. Inflation comes in waves. Just look at the 1960s, 1970s, 1980s. Inflation basically took off in the United States of America and in other currency areas as well, around about 1965 when the Vietnam War started, and it ended in the early 1980s. So many years of high inflation. But inflation came in waves, and I think this is a good illustration of what's unfolding at the moment. The decline in energy prices will bring down headline inflation numbers somewhat, but still there is this enormous monetary overhang, and it will pump up other prices. So I'm pretty confident, actually, that inflation won't come down, and that inflation is actually a huge challenge for all people trying to keep their savings, their lifetime savings, to protect them against the risk scenarios that appear on the horizon. I think inflation is one of the biggest challenges for any investor. Indeed, I think that a certain degree of diversification of a portfolio is important. I'm not a precious metals only guy, but I think gold and silver are basically money substitutes. They're very close to being currencies. And when you just look at the track record of gold and silver, they will protect you against the problems that come with the fiat money system getting increasingly into trouble. Gold and silver cannot be debased. Their purchasing power cannot be debased by central banks running the electronic printing presses, and they also don't carry a default or counterparty risk. So really my recommendation would be to have at least some portion of your portfolio kept in physical gold and silver. And again, I just mentioned diversification. I'm still confident that central banks try to avoid the great contraction, the great depression. And so they will opt for keeping inflation high. And against this backdrop, I think that a diversified stock portfolio is also, or should also be part of your portfolio. And stocks and in particular gold and silver in physical form, in coins and bars in your portfolio, that is at least a strategy that could weather the storm. And for those of you who are less optimistic than I am, I think the option would be to increase the share of precious metals in physical form in your portfolio, and basically to forget about the stock market element.
And which sectors would you say outside gold and silver will perform relatively well in this age of inflation?
That's very difficult to say, Mario. I typically ask myself, am I in a position to outperform the market? And there are just two answers. The one answer is yes, and the other answer is no. And if my answer is no, I wouldn't think that I can outperform the market on a sustained basis. Then the result would be to put together a worldwide diversified asset portfolio with stocks and real estate and precious metals diversified around the globe. And I think this is a recommendation which is appropriate for most investors, because most investors cannot outperform. They don't know which sectors will outperform. And so if you ask me this question, I remain cautious and modest, and so I would recommend a diversified stock or asset portfolio on a worldwide scale.
Just a question about, because there's a lot of people concerned and worried that what's happening now is that the powers that be, the central bankers, they want to bring down the system and introduce CBDCs in order to keep track of everyone, even though they can keep track of us as it is with technology right now. Have you got a view on that, on the CBDC story, whether that will be successful?
You know, my take, Mario, is that these forces don't wish at this juncture to take down the system. I think they want to steer and command the system according to their own preferences. They, I think, try to avoid the big crash, because a big crash would actually put into danger their powerful positions. And so what they have in mind is to transform our societies, our economies over time, gradually, according to the Great Reset agenda, let's put it that way. And of course, digital central bank currencies are an important part of it. Of course, you can see around the world, central banks try to implement these kind of new money, and it depends on whether people accept this kind of currency for transaction purposes, for saving purposes. I think it's a very bad idea if we want to preserve our, or what little is left of it, of our free societies and free economic systems. I really would warn people to get get caught, to get into contact with digital central bank currencies. I think it's really dangerous because it gives central banks all the power. It gives governments all the power to control and to steer you. Private financial privacy would be gone, and hopefully people will revolt against this idea. I think it's a pretty bad idea, and sometimes I'm even reminded of 1984, George Orwell. I think he would have, it goes well beyond the dystopic view George Orwell put out in his book in 1984 as far as digital central bank currencies are concerned. And with that, Mario, I hope I could make clear that I think it's an evil thing, and I hope it won't be established.
I agree 100% with you on that. It is evil because I think the collapse of the gold standard in Europe because of World War I gave them the power with fiat currencies, and this would be a step up from that. It would be total control. So just wanted to ask you if you have any final thoughts for the viewers as we wrap up.
Yeah, Mario, you just mentioned the gold standard collapsed. And I would argue the gold standard didn't collapse. Governments destroyed them deliberately. I think gold and silver are basically perfect money. These are the best media for exchange human society ever had. And governments took them away to install their own unbacked paper or fiat currencies in order to plunder the people, to finance wars. There's no economic or ethical argument that should convince us that government-sponsored fiat currencies would be better money. I think what's needed, Maria, and that would be my final thought, is a return to a free market in money, where people have the full freedom to decide which kind of currency, of kind of money they would love to use for their purposes, for making transactions, for saving purposes. We don't actually need a monopoly of money. What's needed is a free market in money. And hopefully people are going to wake up and read what, for instance, many economists of the Austrian School of Economics put out many, many years ago. They explained the advantages of a free market in money over a government money monopoly. And I think once people start getting into it, they will understand very easily that that our freedom and prosperity can only be preserved if you get rid of government-sponsored money monopolies and return to a free market in money.
Wow, thank you very much, Thorsten, for correcting me there about the gold standard. And I wish you a great rest of the day and a very happy and prosperous 2023.
Thank you very much, Mario, for the invitation. All the best, and I hope we will continue to talk soon.